are adjusting to anti-ESG sentiment or the backlash. I think it's quite a hot, relatively recent topic. And as Brona said, what I'll do is take you through a little bit of a brief history of ESG, and then we'll get into what actually happened, where the boom came from, what it was. And like all booms, there's a bust, and the bust is the backlash, which started about 5 years ago. And we'll talk about that. What was the impact of that? And then, of course, what are the changing priorities now as a result of that? And we'll see, is ESG dead, or is it just changing? Great. So let's talk just a little bit about a brief history of ESG. Starting with what it is. ESG is a framework that evaluates the performance of companies. Yeah. So you have the E, the S, and the G. The E is things like climate, biodiversity, of course, and the S includes DEI, worker safety, and then, of course, governance, executive compensation policy, and all that. I don't think that's news for you all, but it's always just good to get that definition, which I like, at the top of the story. Because then when we look at the timeline, I think most people would agree that the modern environmental movement began with the publication in 1962 of the novel from Rachel Carson's Silent Spring, in which she raised the issue of pesticides and their danger to nature. Silent Spring referred to the fact that if there's no birds, you won't hear springtime. That really was a significant and revolutionary book that most people would agree started the modern environmental movement, which has led to what we now know as ESG. Then there was what they call the Brundtland definition, which was the first time that the word sustainability came into the language, and this definition of development that meets the needs of the present without compromising the ability of future generations to meet their own needs. That was something that was really picked up by countries and by the environmental community and corporations, even as a kind of a more acceptable way to proceed on our common future and on sustainability. I think that's a pretty significant point. Then you may remember, some of you, what they called the Millennium Goals, which was established in the year 2000 for 15 years, which kind of set the path, which led to the Paris Climate Agreement. But it also was the time when sustainability became part of not just countries, but companies' strategies and goals. And even the established targets and guidelines were established during this period. So that was a significant one, and perhaps the most important environmental agreement of our times was the Paris Climate Accord and the establishment of the Sustainable Development Goals. And all of that happened in 2015, a very busy year, where these goals were established to be achieved by 2030 by the United Nations. And most importantly, countries and companies agreed to set targets on the greenhouse gas reduction under the Paris Climate Accord. So from the period from 2015 until 2020, the pandemic, was the boom. And it was during this time that ESG really rose in importance. Even the terminology ESG became quite common. And of course, there was money behind it. There was investing, green investing. You could get discounts on loans if you were able to show that your ESG, that your company was supporting and performing on ESG. So this is really the boom period. And the boom period probably hit its peak in 2020, not because of the pandemic, but in the pandemic. And this is when really, as it says here, ESG grew up. But really what was happening is that investors were putting their money in ESG funds and in companies who were able to demonstrate ESG performance and ESG growth in terms of what they were doing, whether it was social or environmental KPIs. And this led to an increase in valuation of companies who could demonstrate this. And this is really key because it was that increase in valuation that really drove the boom, and of course was responsible to the backlash. And a thing called the ESG premium was responsible for that. And what the ESG premium meant, and you can read it there on the right, that companies, for example, that were maybe up for acquisition, their value rose by about 10% in terms of valuation. And in other words, the price you'd pay for a company went up by 10% if they had a good record on ESG or a good performance on ESG, or even plans to continue that performance, versus a company that had a negative record. So you can imagine the impact here if you're using, for example, EBITDA multiples or enterprise values as a way to evaluate companies that you want to acquire. If that multiple went from 8 to 9 or from 9 to 10 on a multi-million or billion-dollar revenue company, then the impact is significant, 10% on that valuation. And this is a McKinsey survey here that you can see, where the share of respondents saying that these three programs create value rose, really significantly in that boom period up until 2019, continued in 2020, of course, in terms of, is value created by these programs. So this is peak ESG premium time, 2020, the pandemic. And maybe I'm not going to say why in the pandemic it peaked, but it could be that during the pandemic, people, reset their minds a bit and also looked at these things more. But it didn't last long. And peak ESG really started to change very soon after the pandemic in the United States. And this is what we call the backlash period. We're still in it, by the way, so it's not that it's finished. But the backlash period really began after the pandemic in the United States, not just triggered by the culture wars, but that was a feature of the country at the time. But it was really this link between and negativity around the link between woke DEI policies in companies and ESG policies. So many people did not distinguish between those three terminologies, put them all together in one bundle, and framed it as, as a negative thing, but also even economic sabotage driven by political ideology. This is the way it was framed in some parts. Whether you agree with that or not, I'm just stating the fact. My observation is this happened, and this idea that anti-fossil means anti-business took hold. One of the reasons was that some of the state legislation that went through believed that discrimination was happening against companies who were fossil fuel-based companies promoting non-fossil fuel programs unfairly against fossil fuel companies. So this is really where the backlash began, at the state level, at the local level, driven by anti ESG, DEI, woke ideology, but maybe because it was too much in the first place. So it culminated, I think, with the withdrawal from the Paris Accord, which happened earlier this year. Of course, it was one of the first orders that President Trump put through, executive orders, and this really was, peak backlash, let's say, but it's still going on. So then what we saw then this year is another phenomenon, part of the backlash, which you could call green hushing. So a lot of companies backtracked on some of their commitments, and some of them just stayed quiet. So you see this everywhere now, that companies are backtracking on their policies in the US for different reasons. big business is no longer all in on tackling climate change. That could be true also. It's part of this backlash, but certainly they're not as loud about it as business was several years ago. And the banks has been a big one. You can see in the bottom left there, there was this, there are several initiatives regarding net zero, and one of them was the Net Zero Banking Alliance. And several banks pulled out of that during this year as a result of this backlash. And the alliance itself has paused activities. This is fairly recent news, following these high-profile departures from the ranks. So it's going to restructure and maybe even disappear. We're not sure yet, but it's certainly not going to be the organization that it was, which was fairly significant at the time. So many companies have scaled back their sustainability commitments, and in general, I think we can say that big business is slowing its climate targets and goals. I don't know if it's abandoning, as this particular article says, but the backlash, we all feel it. So what was the impact then in Europe? This is mostly in banking and large corporations, and it started in the US, but even in Europe on legislation, there has been some backtracking. This may not be directly linked to the same motivations as in the United States, but there's a pushback also against some European legislation, which is part of the EU Green Deal, just because of the burden on companies that legislation represents. And this is much more prominent in the last 12 months than it has been in the last 5, especially in Europe, which is considered to be one of the beacons of sustainability legislation. And the EUDR, which is the EU deforestation laws, is just an example of those, where this time last year, the deforestation legislation, which proposes that all companies should demonstrate where all their raw materials, at least linked to 5 commodity raw materials, are coming from, to show that they have not come from deforested areas. It sounds like a good idea, but in fact, the details of it were criticized and challenged. So it was postponed for a year, and now just yesterday, we heard that this was postponed again for 1 more year because of the difficulties of many large corporations and small, in particular, in implementing such a law, which is very, very complex. It's not as simple as it might seem. And then, of course, you probably all know about the omnibus proposal related to CSRD, Corporate Sustainability Reporting Directive, which we were all very busy with for the last few years preparing for. Now it has been not postponed, but scaled back. In particular, it's removing a lot of medium and small-sized companies from the need to report, as was expected in 2026. So without getting into all the details on corporate sustainability reporting, it's a significant change, this omnibus, because those companies now, maybe they had hired people even to manage this CSRD, and all of a sudden they don't need to maybe continue with those people in that area. So a really significant scale back in European legislation also. And I do believe that scale back is part of the overall backlash that started in the US and we're seeing now. So with all that said, where are we? Where do we stand? Is ESG dead? So I'd love to hear any of your comments on this if there was questions, but this is the question: is it dead, or is it just changing? Well, if you look at some of the data that's available, it's a mixed bag, right? Because in the United States, you can see the assets linked to ESG have actually dropped quite significantly over the period 2018 to 2025 because of the backlash and because of a redefinition of ESG valuation that is happening in the United States. In Europe, it's pretty stable and similar levels of investment money. But then you've got other regions that are growing. Of course, they're smaller, but they're growing in this area. And China isn't even mentioned here. I guess data wasn't available, but China is another area where ESG investment is still significantly growing. Yesterday, they just announced some new greenhouse gas targets for 2035 for the country, for China, which I think was welcome news for many in the environmental community. Maybe not enough, a 10% reduction, but still pretty important news in that sense. And of course, differentiating themselves from the United States in that sense also. So there's still significant ESG investment out there, although in the United States it's dropping. But if you look at the market size, it's still really significant. And this ESG market size is split into different areas. Most of it, of course, is in investing. And this is the investment that I mentioned earlier that is still providing value for companies. If you're performing well in ESG, it still does make a difference to your valuation. And there's a lot of consulting around that, which is also a big number here. But by far the largest part is ESG investing. And look at also even the green finance and green bonds. So that this is, you can access capital at reduced discount rates, at discounted rates, if you can prove that your company is achieving and meeting certain ESG targets. It's like a discount on your interest rate. So there's still a lot of money in this area. And my suggestion is that it's not yet dead, let's say, and in fact, it's just changing. It's resetting. So ESG is dead, long live ESG. So it's still there, but just in a different form. And I believe that the business case for sustainability-driven transformation still remains. It's still there. People are still investing in this. It's still important for customers, and I'm in a business where customers still need it, but they don't need it in the same way. They need it in a very concrete way. And how does it help me improve my performance? So that's the way it's directed, and there's real value there for sure. It's already embedded in most business strategies, because businesses like ours that started this journey 10 years ago, we've already embedded it all in the different divisions of our company. It's not just a department of sustainability telling the company how to behave. It's already embedded, and we're just there to support the business purchasing strategy, financial strategy, research, etc., etc. So I think that's the case, that it's already embedded, so it's not going to go away in that way. And most importantly, company valuations are still based on ESG performance partly. So that will remain. It may be less in certain regions. It may be more emphasis on different things. Maybe the emphasis on greenhouse gases might decrease versus other emphases related to sustainability priorities, which will come up in the next few years, like biodiversity, circularity. They probably will take on more importance relative to the laser focus in the last 10 years on greenhouse gas emissions, of course, and carbon dioxide. However, as I said, customer needs will still, and this is maybe obvious for those of us in business, will still be prioritized. And what I mean by that is that sustainability programs can support customers to achieve their goals still. And that's really where the value is. Rather than just pronouncing how great you're going to be on meeting your targets, it's more about how can you help your customer meet their targets. That's really where the value is, in my opinion. This is not something that everybody necessarily has said, but I do see that in the market, certainly in our market, which is chemicals related to fashion. We see that. So ESG will in the future be less about box ticking, that I've got my targets, I've got my ESG report, I've got my report on substances, etc., and branding. It'll be more about strategic planning. So it's, like I said, this embedding in the company is already there. So any company that's planning to grow or planning a strategy, then ESG just will be part of that. The third bullet there is very important, that claims about sustainability will only be accepted with empirical evidence. And this is great news for those of us that are reluctant to make claims because we're conservative about making them if we're not absolutely sure. Whereas we see many other companies maybe making claims about things that we know cannot be correct, but they're still allowed out there. So this is coming with legislation, but with also a general acceptance and a general skepticism about sustainability claims. I do believe that this is good news, that data needs to be provided in order to make any claim about your product or your company being more sustainable than another. And this is excellent news, I think. And it's all about transparency. All the legislation in Europe in particular that's coming is about disclosure. It's not necessarily telling you what you have to comply with, but it's telling you to report and to be transparent. And if you don't report something, why not? So flaws and all, we have to report the good and the bad. And that's also generally a good thing because it will lead then to the empirical evidence culture coming into business. I expect and hope that ESG legislation will be simplified. The evidence is coming on that in the European Union. These postponements and scale downs of some legislation, I think, is an indicator of that. It's just getting too complicated for companies to get their heads around some of the complication around legislation. And some will just go out of business if it were to continue with its complexity. So I do expect that will be simplified. And as I've spoken before on these webinars and some of these masterclasses, life cycle assessment data is a critical KPI now for companies because it tells you what is the footprint and the environmental impact of any product. So there is a boom in the provision of this data and the generation of this data. And many companies have appeared who are consulting or even data companies providing the possibility to generate this data. So there's a bit of a boom there, and that will continue. That will continue because we see that customers, companies still want data. They may not want your stories about all the good things you're doing in the community and climate and emissions, all of that. That's fine. But what they really want is good, reliable primary data for the products that they are buying. And that requires life cycle assessment. That's the most popular methodology to get that. So the boom in that will continue, in my opinion. So in summary, that's I think where we are. It's not dead. Long live ESG. And reports of my death as an ESG director have been greatly exaggerated. I think this is a Mark Twain quote that I have borrowed. Like I said, I think you could call it a reset, you could call it a change of position, but ESG is still very much part of business now, embedded, maybe not at the front end like it was 5 or 10 years ago, but it's absolutely part of strategy going forward and still will be. So thank you very much for your attention.
The great insights. You mentioned the escalating importance of empirical data to support sustainability claims. What type of data will companies need to provide to back up their claims or targets on Scope 3 emissions, for example?
Yeah, we should distinguish, and I think I did this in one of the masterclasses, distinguish between corporate emissions, which is what your company reports, and a life cycle data or product carbon footprint data, which is for your product. Yeah, so the data that I was talking about before is both really. But if you have a product that you're selling, then you need to provide life cycle data that has been properly verified and using a methodology that's known and a calculation method and state those methodologies on your life cycle data declaration. When it's corporate emissions, you need to have that audited by a third party that's specialized in corporate GHG emissions, Scope 1, Scope 2, Scope 3, to make sure you're doing it properly. If you're a big company, you probably already are doing it with the big 4 consulting companies. If you're a smaller company, there's a lot of smaller ones popping up now who are very keen and good at this, who can verify your data at a much more reasonable price. But you need to quote that company then when you report the data. So that's the best way to do it. Have it verified by third parties. Use calculation methods and methodology that's generally accepted, like ISO or life cycle data, whatever it is. Yeah.
Thanks so much for everyone joining us, and thanks for sharing your expertise as well, Michael. Hope everyone has a good day ahead.